Numerous other accounting frauds committed, but these were the biggest and most impactful. But there's another part to this. What about the auditors? The job of an auditor is to look over all these financial statements to ensure the company's position is fairly represented. Every public company legally has to have their financial statements audited. The primary purpose of an auditor is to prevent things like this from happening, so the investors can confidently use the reports to make informative decisions. Had the auditors done their job properly, they would have seen red flags all over the place. But they weren't doing their job properly. They weren't really doing it at all. They were being paid by Enron to look the other way. The name of these auditors? Arthur Anderson.
Hi there. I'm Safwan Hafiz from Executive Diploma in Administrative Accounting, University of Malaya, Kuala Lumpur. And in this video, I'm going to explain to you the role of auditors in corporate governance and tell you a little story about those short clips before. Who are those people? What happened to them? And what can we learn from their mistakes? So, stay tuned to find out more. So, here we go. What is all about those clips that I have just shown you before and why there is bribe going on there? And who is Arthur Anderson? To start, let me explain about auditors and what is their roles in corporate governance. An auditor is an individual who examines the accuracy of recorded business transactions. Auditors are needed to verify that processes are functioning as planned and that the financial statement produced by an organization fairly reflect its operational and financial results. Auditors assess financial operation and ensure that organizations are run efficiently. They are tasked with tracking cash flow from beginning to end and verifying that an organization's funds are properly accounted for. In the case of public companies, the main duty of an auditor is to determine whether financial statement follows General Accepted Accounting Principles or GAAP. To meet this requirement, auditors inspect accounting data, financial records, and operational aspects of a business and take detailed notes and on each step of the process, known as audit trail. Once completed, the auditor's findings are presented in a report that appears as a preface in a financial statement. There are 4 types of auditors. 1. External auditors. 2nd, internal auditors. 3rd, forensic auditors. And lastly, government auditors. In this video, I will explain external auditors and internal auditors and their roles in corporate governance. First, who are external auditors? Hence the name, an external auditor is a third-party consultant who independently review a company's financial records, including purchasing records, payroll, accounts payable and receivable, expense report, inventory, and tax payments. External auditors look for financial misstatement resulting from errors, fraud, or embezzlement, while an internal auditor was performing the same function as an internal auditors, except that they are employees of the company they are auditing. Internal auditors are important to a company's decision-making process as they are looked at aspects of the business such as risk management, corporate governance, organizational objective, operational efficiencies, and compliance. Internal auditors identify and help rectify problems before an external audit. What were their roles actually in corporate governance? The board of directors is ultimately responsible for the organization's effective governance. Corporate governance is the collective name given to the various policies, rules, practices, and processes established by the authorities of the board to govern the organization effectively, monitor its application, and meet its objective. Internal audit can play a key role here, providing what is sometimes known as the third line of defense. According to an article by the Institute of Internal Auditors, based in the United States, quote, audit role in governance is vital, and internal and external audit provides objective assurance and insight into the effectiveness and efficiencies of risk management, internal control, and governance processes. A vibrant, agile internet audit function can be indispensable resource supporting sound corporate governance. Auditors can give additional value by including reviews of the organization's processes and procedures in areas such as 1. Corporate culture. 2. How to identify and manage risk. 3rd, sustainability. 4th, cybersecurity. 5th, businesses planning. And lastly, 6, geopolitical risks. Now, let's talk about Enron, what happened to them in a brief. Enron was one of the largest US-based enterprises providing wholesale retail, broadband, and transportation services. Poor corporate governance caused the company's failure. Enron bankruptcy on 2nd December 2002 launched a new period of revolutionary reforms to corporate governance globally, focused on legislative reform to prevent or reduce future company collapses. Enron's shift from an online energy corporation to a high-tech worldwide trading energy enterprise is considered and innovative. Let's take a look into their timeline, shall we? And it all starts with good intentions. In 1990, CEO Kenneth Lay hires Jeffrey Skilling to lead the company's effort to focus on commodities trading in the deregulated market. Andrew Fastow is one of Skilling's first hire later that year. Kenneth Lay merged Houston Natural Gas and Internorth to become Enron in 1985. Several years later, when Jeffrey Skilling was hired, Lay established a crew of executives that hid billions of dollars in debt from failing ventures and initiative. Chief Financial Officers, CFO Andrew Fastow, and other executives deceived Enron's board and audit committee about high-risk accounting practices and urged Arthur Andersen to ignore them. In 1999, Fastow created the first of two partnerships, LJM, which purported to buy poorly performing Enron assets and hedge risky investments. It helped the company hide debt and inflate profits. Pretty smart, right? Which in August 2000 shows the impact of Enron's market shares by reaching a record high of $90 per share. Like all Malaysian proverb says, sepandai-pandai tupai melompat, akhirnya jatuh ke tanah juga. On October 16, 2001, Enron announced a 638 million loss in the third quarter and 1.2 billion reduction in shareholders' equity. This then led to an inquiry from the Securities and Exchange Commission, or SEC, about Enron finances. In late November 2001, Enron stock plunged to as low as below $1. Enron stakeholder launched a 40 billion lawsuit after the company's stock price collapses to less than $1 per share by November 2001. The SEC initiated an investigation and DNG offered to buy the company cheaply. Enron then filed for bankruptcy under Chapter 11 on December 2, 2001. Enron's $63.4 billion in assets made it the greatest bankruptcy until WorldCom in 2002. We are talking cents here, not dollar. 26 cents per share. And in December 2001, Enron filed for bankruptcy, which led to the sentence of the CEOs who were all charged with a felony, including Andrew Fastow, Kenneth Lay, and Jeffrey Skilling respectively. The auditors firm, Arthur Andersen, was found guilty of improperly destroying SEC papers, which led to the firm's closure. Before the US Supreme Court overturned the verdict, Arthur Andersen had lost most of its customers and discontinued operation. Despite losing billions in pensions and stock values, Enron employees and shareholders secured major litigation returns. As a result of that incident, new regulation and laws were passed to improve public company financial reporting. Sarbanes-Oxley Act, or SOX, exchange penalty for destroying, changing, or falsifying records in government investigations or for defrauding shareholders. The Act strengthened auditors' firm accountability to stay impartial and independent of our clients. The Malaysian Code on Corporate Governance, or MCCG, introduced in the year of 2000, has been a significant tool for corporate governance reform and has influenced the corporate governance practices of companies positively. The MCCG reflects globally acceptance principles and practices of corporate governance which are above and beyond the minimum required by statute regulations or those prescribed by Bursa Malaysia. The MCCG was reviewed in 2007, 2012, 2017 and recently 2021 to ensure that it remains relevant and support the inclusion of good corporate governance, culture and practices. There are three main principles that are crucial to Malaysian corporate governance, and we are going to look at all three by having Enron as a perfect example to give the best perspective. Principle 1, board leadership and effectiveness. And for summary, the board is accountable for a company's long-term success and stakeholders' value. The board must govern and set the company's strategic direction while overseeing management to fulfill fiduciary and leadership roles. The board sets the company's tone, provides thoughts, leadership and promotes good governance and ethics. While board's function and responsibilities are well established, directors' expectations have changed due to corporate, economics, and social changes. In understanding and developing the company's strategic orientation, directors must be more vigilant and skeptical. Effective board leadership and oversight require the integration of sustainability considerations in corporate governance strategy and decision-making. Sustainability and its underlying environmental, social and governance or ESG issues are increasingly material to companies' ability to create durable and sustainable value and maintain stakeholder confidence. To be resilient, board must adopt a holistic perspective of the business and take proactive, effective action to anticipate and handle ESG risks and opportunities. Companies with a well-articulated long-term strategy and a clear sustainability plan will strengthen the confidence of their stakeholders such as consumers, investors, legislators and regulators. Unprepared boards and organizations may suffer as stakeholders lose trust in their ability to respond to global upheavals and changes. Board composition affects its supervisory duties. An effective board should include the correct abilities, knowledge, experience, and independent aspect to meet the company's strategic goals. The correct board composition will ensure diversity and independence to avoid group thinking or blind spot in decision making. It helps the board respond to issue and delivers value. Well-structured director compensations that rewards long-term achievement is vital to corporate stability and growth. Inadequately linking directors' pay to firm strategy and performance can reduce shareholder returns, damage corporate governance, and reduce public trust in business. Now, what happened to the board of directors of Enron? In most states, directors function under the business judgment rules, which gives them the considerable freedom to make good faith business judgment, absent fraud, gross negligence, or other misbehavior. Most states allow corporations to identify directors from civil, criminal, or administrative proceedings against the company. Most US publicly traded corporations, including Enron, purchase directors' liability insurance that pays for directors' legal expenses and other costs in such proceedings. Among the most significant board function is ensuring that the company's financial statement correctly represent its financial status to shareholders and in the investing public. This responsibility goes beyond assuring GAAP compliance. Technical compliance may be evidence of good faith, but it's not conclusive, according to the Second Circuit Court of Appeals. In the US, the board of directors is a company's highest authority. A typical board reviews the company business, strategies, select and compensate senior executives, evaluate the outside auditors, oversees financial statement, and monitors company performance. Business Roundtable says the board paramount obligation is to protect shareholders' interests. State statutes require directors to act in good faith with reasonable care and in the corporation's best interest. Courts examine three fiduciary obligations. Despite claiming to be the victims of a cruel hoax and being misled and educated about critical corporate action and objective, all Enron board members knew and supported the company's strategies to maintain its investment credit rating, increase the cash flow, and reduce debt. The board was well informed and authorized many SPEs hedging operations. The board, especially Kenneth Lay, who was the chairman and CEO, was warned of the risk of accounting scrutiny by performing this transaction at the Finance Committee in May 2000. Yet, the board completely ignored the red flag and approved a series of hedge contracts with its SPEs that were designed to help Enron avoid reflecting losses caused by fall in merchant investment on its income statement. The board enabled CFO Andrew Fastow to form and become the sole manager of a private equity fund, LJA Cayman LP, to do business with Enron, which lacked economic substance. He was also permitted to be a general partner in other firms formed to profit at Enron costs. This breach impacted Enron's financial status by removing debts and inflating earnings and cash flows. This allowed Enron to move several billions worth of assets with a delayed cash flow to its unconsolidated affiliates and report extravagant earnings. Such unconsolidated affiliates didn't match the conditions. The board was also apprised of the rise in prepaid transactions, which were misclassified as trading liabilities and cash flow from operation instead of debt and cash flow from financing. Based on this evidence, the Permanent Subcommittee on Investigation concluded that Enron's board knew of and approved of high-risk accounting methods, notably billions of dollars in off-the-books activity, targeted at dramatically improving its financial conditions. The role of executive officers. As we all learned by now, the executive contributes significantly to the Enron strategy. The construction and administration of SPEs serve the self-interest of the CFO and other Enron workers, leading to the company's bankruptcy. SPE-related problems may have been averted if the CEO had acted in Enron's shareholders' best interest. Under Enron's code of conduct, the CEO had to evaluate, approve, and control Enron LGM partnership transaction to ensure fairness. The CEO approved the CFO doing business with Enron and unlawfully controlled transactions between his partnership and Enron, allowing hundreds of millions of dollars of Enron expenses to be turned to his colleague and advantages. The CEO also used his credit line to borrow money from Enron, which is 77 million, and repay it with Enron stock. This action shows that the board lack of control over Enron business and compensation and the CEO's self-interest. In this perspective, Ken Lay's dual job for a lengthy period contributed to the absence of adequate governance that led the firm to bankruptcy. This finding is backed by the recommendation that a single individual without a salary should not dominate the company management. Separating the CEO and the chairman roles improve corporate governance. Now, let's take a look on principle number 2, effective audit and risk management. And for summary, effective audit committee oversight requires transparency, attention, and independent judgment. The complete board is responsible for a company's financial reporting in a company's governance system. The audit committee is crucial. An independent audit committee can better examine the company's financial reporting, internal controls, risk management, and governance. The audit committee's capacity to fulfill its obligation depends on its members' knowledge, abilities, experience, and commitment. Strong financial reporting process, knowledge, and different viewpoints can improve audit committee debates. Risk management and internal control are vital for firms' governance, management, and operations. Risk management identifies hazards and opportunities, while internal controls help counter them. Proper risk management and internal control help firms to make informed risk decisions and execute the appropriate controls to achieve their goals. Successful firms integrate governance structures and processes with performance-focused risk management and internal control across all operations. The board oversees risk management and internal control mechanism. It should develop internal control procedures and ensure system effectiveness. The board must guarantee that internal control manage risk and fit its business culture. Audit committee involving external and internal auditors are needed to work hand in hand as the whistleblower for any wrongdoings in the financial statement of the company. The role of internal auditors and external auditors in Enron scandal. Internal audit is a key part of company's governance. Arthur Andersen provided Enron's internal auditors 4 years. The lack of effective internal audit department contributed to Enron's collapse by increasing the likelihood of undiscovered fraud, questionable transactions, and profit management. Outsourced auditors may have impacted the audit department effectiveness due to their inadequate business knowledge. Enron should have developed its audit department so internal audits might have improved corporate governance. Internal audit should evaluate internal control effectiveness, undertake a risk assessment and management processes, ensure procedural compliance including IT system integrity, and produce audit committee brief. Arthur Andersen's Enron external auditors also contribute to the tragedy. The auditor's responsibility is to provide reasonable confidence that management financial reporting is accurate and fair. External auditors must be objective and devoid of financial interest in audit clients. Enron's external auditors accept the company financial statement and hid the company problems. First, the economic tie mentioned before could have caused this. Arthur Andersen was paid $27 million for non-audit service and $25 million for audit work by Enron to increase its revenue. Thus, it seems likely that Arthur Andersen audit works for Enron was compromised by conflict of interest between safeguarding its professional image and acquiescing to Enron's management. Arthur Andersen's inability to uncover the client management complex financial vehicle is also blamed for their acceptance. Arthur Andersen failed to generate quality audit report and destroying tons of Enron's documents demonstrate its fiduciary shortcoming. Enron regulatory environment and corporate governance plan made risk management important. Enron hedged long-term fixed commitment because of energy price and supply uncertainty. Enron's strategy was to expand its purchases in highly leveraged energy and financial products sectors in reaction to projected competition, which would increase the chance of non-performance. Enron's debt to equity ratio rose, increasing its financial risk. Enron also diversified its offering. Enron needed internal capital to pursue development and opportunities. Enron Risk Assessment and Control Group management market risks. No risk, no gain is the company's motto. Innovation is intelligent. Gambling to simplify. If a company has risk management method and people gambling is smart, executives make risk management decision in the restructured company, considered board SPE choices. The board was presented with risk management profile for SPE transactions. Now, for the last principle, principle number 3, integrity in corporate reporting and meaningful relationship with stakeholders. And for summary, engaging and communicating with stakeholders build trust and understanding. It shows stakeholders the company's goal and management quality. This will let stakeholders evaluate the companies and help shareholders vote. The corporation can utilize the input to understand stakeholder expectation and establish a business strategy. Directors and senior management use general meetings to engage shareholders and explain the company's strategy, governance, and performance. General meeting help shareholders exercise their ownership right and voice concern to the board and senior management. At general meeting, shareholders should ask questions, offer opinions, and vote. The corporation should use technology to boost shareholder participation and general meeting proceedings. Communication with stakeholders. Process integrity capacity is sustained moral awareness, deliberations, characters, and behavior. Alignment that result in reputational capital. Fragmented managerial moral attention and behavioral arouses stakeholders concerned about the moral hypocrisy of management practices. In example, Enron top manager took their public relation image as responsible corporate citizens while defrauding investors and employees and secretly lining their own pocket with diverted funds. Enron executives probably saw the moral difficulties, but they weren't sensitive to them. When challenged, as Fasto was about his financial system, they retaliate against accusers and sought a material that confirmed what they already believe. Management and board members become morally blind, deaf and mute after ignoring whistleblower criticism, reducing their capacity for ethical awareness and strategic response, for which they are morally liable. The second component of process integrity is moral deliberation, which involve evaluating causal variables and moral options to arrive at a balanced and inclusive, acceptable decision, resolution or policy that sets a standard for future decisions. With the scaling faster corporate cycle, the focus is on the short-term financial consequences of a moral decision, while excluding other characteristics that can impede decisive action of executive reward. Enron leadership and board members overlook or trivialize to the harm caused or other stakeholders by faulty analysis and self-centered policies. Enron managers are ethically liable for their reduced moral deliberations. For a conclusion, what can we learn from the Enron scandal? Many reasons contributed to the high-profile collapse of Enron. This research found that Enron's demise was due to weak governance structures and practices. Enron's board of directors allegedly breached its fiduciary duty to the company's stockholders. The board accepted high-risk accounting procedures, failed to avoid conflict of interest, and didn't sufficiently oversee the important business and executive compensation choices. Enron's senior executives were selfish and acted in their self-interest, harming Enron shareholders. According to the study, on behalf of Enron, Enron CEOs proposed and was approved to set up private equity funds as SPEs. Enron CEO, like the CFO, did not act the best interest of the shareholders, since Fasto was allowed to profit from unfair transactions that hurt Enron stockholders. Enron employees saw top leaders' misbehavior, but few spoke up. Enron's poor whistleblower system made its weak corporate governance unavoidable. Enron's external auditors accused with management in the application of dubious accounting and deceptive financial reporting because of its economic dependence on the corporations. All of these internal corporate governance issues contribute to Enron's problem, which led to its bankruptcy. First, Enron directors failed to avoid major conflict of interest. According to the study, as indicated before and widely addressed in the literature, Enron's downfall was caused by manipulating high-risk accounting procedures. This tactic thrived due to Enron's conflict of interest, especially the CEO's huge remunerations and returns for favoring SPEs and acting in his interest. Increasing conflict of interest regulation is an effective way to prevent corporate failure. Second, some executives oppose separating the CEO and chairperson roles. Similarly, US law did not necessitate the separation of their roles of CEO and chairman. According to excellent corporate governance, a company's organization structure should not allow a dual duty for the CEO. Theoretically, a chairperson represents shareholder interests. He or she monitors and advises executive officers' operation to serve shareholders. Separating the roles of CEO and chairman allow the board to assess managerial performance and prevent conflict of interest. The board should also have the right to appoint and fire the CEO. Due to the incidents of CEO contributing to the business collapses, such as Health International Holding Insurance, the position of CEO and chairman must be separated. Research also implies that board duality raises the risk of fraud and earnings manipulations, ineffective management monitoring in a result of a single individual dominating management without compensation control. In the case of Enron, Ken Lay dual job contributed to poor governance, which led to bankruptcy. These scenarios prompts more research on the usefulness of the dual CEO in corporate governance. As for the auditors' aim, despite different evidence on how economic bonds affect on auditors' view, many rules follow the SOX Act 2002 to prevent or restrict the auditors from providing non-audit services to its client. This report recommends more research to assess global corporate governance regulation. Here is the good corporate governance model for Enron-like collapse prevention. Please have a look. That's all for this video. I hope for more educational content like this in the future. Signing off, my name is Safwan Hafiz. Thanks for watching.